First off, thanks everyone for attending. Appreciate it. My name is Jarrod Hageman. I'm a financial advisor here at the Noble Group, and really grateful today to be able to spend just a little bit of time. I think we're going to maybe target 30 minutes, maybe a little bit less, to go over some principles of long-term investing. And when we scheduled this education session, we didn't know, of course, that the market was going to enter this recent kind of bout of volatility and concerns with tariffs. But I think it's just timely that we take a few minutes today to just kind of recenter and think about some of these basic long-term principles, refocusing on our goals. So we're just really glad that this presentation kind of landed fortuitously when it did. So hopefully it's helpful. And with that, before I jump right into some of these principles and these slides, just some disclaimers here. One, this is from MFS. We thought it was a good presentation, so we're utilizing it from MFS. They're not associated with the Noble Group or LPL Financial, our broker-dealer, and LPL and our broker-dealer and registered investment advisor. Everything we're going to talk about today is really educational in nature, not investment advice. And in the investments or the returns referenced, they're not FDIC insured and may lose value. And of course, there's no bank guarantee. And with that, let's jump right in and start talking about kind of some of the building the resilience for long-term investing. And it's becoming much more challenging in our current world. All right, I'm going to throw this slide up here. All right, and you're going to see words that that invoke some emotions. Of course, right? Pandemic. We just had a child during the pandemic. If I bring up pandemic or COVID, my wife immediately has a reaction. Of course, economic disaster, credit crunches, crash, emergencies. Of course, tariffs here recently. These headlines are grabbing, right? They're there to absolutely kind of create panic, which can, of course, create some anxiety as well. And I think just being aware of that and realizing it is important. All right. We want you to feel your feelings here at the Noble Group, right? But we want you to not act on those feelings and really try to make, when it comes to investment decisions, clear decisions based on data and your needs. Okay. And it's becoming more and more challenging. And we get that. If you look kind of over the decades, in 87 through 97, of course, you could turn off the TV or you could not read the newspaper, but those were primarily the drivers of the information that you got. We entered the internet age, and more information kind of got bombarded at us. And then here in the last 2007 through 2024, we're entering the social media age, where you really can't get away from news, from really messaging. Almost anybody anywhere can post, and that is absolutely playing on us as humans. And we're going to go through some behavioral finance issues and how that impacts us. All right. Now, to add even more to the kind of the onslaught of news that we get, investing's become more complex. Now, part of this is just some of the low interest rates that we saw since the Great Recession. But in 2005 through 2014, a portfolio that included 75% fixed income and only 25% US large cap stocks, all right, achieved a 5.7% return with a volatility of 4.5%. We use standard deviation to measure that volatility. If we look from 2015 to 2024, that same return of 5.7% required a much more complex, riskier portfolio, right? Almost twice, it's more than 2 times riskier, the portfolio, to achieve that same amount of return. And instead of being primarily in fixed income, it was only 45% fixed income, a sleeve of real estate, a 22.5% US large cap, a 22% US non-US equity as well, to achieve that same 5.7% return. So we definitely know we've got a lot of news, we've got increased complexity. It makes it even more important today to really kind of land back to some basic principles. And here's principle number one: understand that the market's going to move. It's going to move up. It's going to move down. It rarely moves sideways. All right. And I think this chart is a good example of what we're facing when we look at market movements. this bar chart is going all the way back to 1980, and it shows the returns year in, year out of the S&P 500. All right, so you can see last year up 23%, 2023 up 24%. But I want to point out these dots. These are pointing out the max drawdown. And the max drawdown is in that calendar year, the high to the low. What was the biggest kind of loss throughout that year? And you'll notice some pretty big numbers, right? If you go back to the Great Recession, at one point down from high to low, negative 49%. Boy, that was a tough year. The market was down 38%. All right, but I want to point out a couple areas where, look at COVID 2020. From high to low, the market at one point was down 34%. It ended the year up 16%. I had a mentor once tell me, this is kind of what you have to endure, the cost you pay of volatility. You were down that 34% in order to achieve for that year in 2020, that 16% positive return if you were in stocks. Markets are going to move, right? But they've also been kind of resilient over time. And you can see this by the vast majority of these returns over the years have been positive versus negative. Of course, we've got the tech blow up of the 2000, the dot-com bubble, the Great Recession, of course, 2022, interest rates rising, inflationary concerns. But once again, really the vast majority of these years showing some really nice positive numbers. Now, if we look at the same chart on the bond market, there's less volatility in fixed income and bonds, okay? But you can still see some in multiple years, almost every year, there was going to be a 1 point a loss. But the vast majority of fixed income returns were positive throughout the years. Of course, 2022 being a good exception with interest rates really rising there. All right. So volatility, it's challenging. All right. But historically, declines were short term, right? And you kind of had to bear that to really take advantage of the long-term returns. All right, and this volatility is normal, right? Here's our second principle. Volatility is absolutely normal, okay? If we go back to 1940, wanted to kind of give you the chart of the Dow Jones, kind of where we're at here, a little less than 100, all the way up, all right, over 10,000. All right, and throughout that, we saw bull markets and bear markets. Bear markets are defined typically as a pullback of 20% or more. So you can see these bear markets outlined in red throughout the decades. Okay, so, here's 2008. Right here was the Great Recession. We had a bear market of down negative 53.8%. On average, though, I want to point out that the average bear market was down around 31%. And the average duration, so how long that lasted, was about 1 year. All right. The equivalent, though, bull market, the market has gone up. And of course, it doesn't go up in a straight line. There's ups and downs. But the average bull market is up 141.4%, and that average duration was 4 years. And once again, the way to think about this is you kind of have to bear some of this volatility and downturn in order to achieve the returns, at least historically speaking. All right, same thing, same chart, but now we're looking at the Bloomberg U.S. Aggregate Bond Index, and this is showing the bull markets and bear markets within fixed income. All right, average was only down 9.2%. It lasted around 4 months, but the average up market 34.1%, and that was approximately lasting 3 years. So. Hopefully this kind of helps kind of paint that picture of kind of the importance of staying in long term. All right, third principle. All right, we're moving right along. Control your emotions and behavior. There has been some just tremendous in the last decade or two research on behavioral finance. It's really helped, I think, our industry, help the retirement plans, focusing on getting people in plans. But there's some basic principles. I think it's important to be familiar with them. One here, loss aversion. We feel pain, all right, 3 times the pain from a loss as the pleasure from a gain. right? Losing $100 is 3 times worse than the equivalent, finding $100 on the street. This loss aversion really does control a lot of investors, and it's something to just be aware of, right? And this impacts not just in investing, but in general life as well, right? How many times have we not spoken up because we fear we might be judged, right? Or this is my favorite example, is the student that doesn't study for the test because of the fear that they might fail the test. All right. Or just not investing at all for the fear that, boy, I might see a loss in my account. All right. This is a very powerful driver of behavior and something to be aware of because, right, investing does come with volatility. Couple other things, how our minds work against us. A few things to be just aware of. There's something called familiarity bias. And there was a study done on familiarity bias where we tend to invest in what we know, right? And so people in Texas, when you look at participants, there was a study done on this. They tend to overweight oil and gas companies because there's more oil and gas companies and they might be more familiar with that. Same people in California, though, tend to overweight technology companies. Of course, Silicon Valley and more companies in California are tech companies. So, right, that can influence some of the benefits of diversification. All right, diversifying holding, of course, a diverse, broad spectrum of investments to minimize any potential loss in one area. So just be aware that we're all subject to familiarity bias. Anchoring. Anchoring is an interesting one. Anchoring is relying on the initial reference point. A lot of investors do this with stocks. For example, if they buy a stock at $20 a share, let's just say that stock was down. And instead of making the decision to keep it, add more, investing it, they might say, and a lot of investors do this. I'll sell it as soon as it gets back to $20. Well, yeah, that's really not relevant in the decision on whether that fits in your portfolio and should be in your portfolio. So anchoring is something to just be aware of. Oversimplification, politicians are subject to this one. Also, in investing, it can be we're subject to this. And oversimplifying is right is we live in a very complex world. Investing is extremely complex. There's multiple intersecting causes for a lot of outcomes, and to simply say one thing is the impact is generally not true. Hindsight bias. Hindsight bias is also a very common, way our minds work. I use this in sports all the time. If you'd have told me, I could have told you absolutely U of H was going to make the Final Four. I knew it; they were going to make it. Right? Of course, I had no idea. I was hopeful, but I had no idea. We do this a lot. All right, especially with investing. So how does our mind work? Some of these loss aversions and gain, how do they impact our success? Well, one, there's the endowment effect, which is simply putting a higher value on something we own than what others think and the market might price it at. I do this with my truck. I have an old truck. I bought it in 2002, and I've talked about getting rid of it for years, but I haven't. Because I think it's worth a heck of a lot more than anybody else will pay for it. We do this as well with potentially the investments that we hold, especially housing or more illiquid investments because of the sentimental value that they might have for you. Status quo is simply kind of not making a decision, keeping on going, not making a decision that might be in the best interest to actually make a change. My favorite joke on status quo is two people digging a hole, and the one says to the other, "Hey, I've got this shovel. Why don't you use that?" And the other person saying, "No, I'm good. I got this spoon." All right. Clearly, they should be using a shovel. So status quo, be aware of that. And then the bandwagon effect, we're all familiar with, right? Jumping on because everyone else is doing it, whether it fits with your risk tolerance, your goals, your objectives. All right. So how does this manifest in the investing world? Well, this chart says a lot. All right. What this chart shows us is that the average investor underperforms. And it's because of the way we're kind of inherently wired as humans. All right. The S&P 500 over the last 30 years, from 1994 to 2023, positive 10.15%. The average investor over that time period, 8%, right? Why is that? Why did that average investor earn less? It's because they zig when we zig when we should zag. They sell it when the market's down. They buy when the market's high, and then limiting the overall return. Where just simply staying invested, and being patient, would have achieved a higher return. Same thing with U.S. bonds. This was I found fascinating with bonds. If you'd have just stayed in the U.S. aggregate bond over those 30 years, positive 4.41%. The average bond investor, though, was actually negative over that time period. All right. So be aware of some of these biases, how we kind of think, and the news that you get. Those are all areas in which can influence you to potentially not make decisions that are not in your best interest on the investment side. All right, fourth principle, take a longer view. And this is, I think, really important because when you step back and take a longer view, it really does matter when you look at your overall performance. And also, for most of us on the call today, one of the primary goals is retirement. And retirement investing is not a short-term goal. That is a 20, 30, 50, 70-year time frame of working and then decumulation in retirement, where if you live for 10, 20, 30 years in retirement. So when we take a step back and we look at volatility, the ups and downs of the market, this is a really great chart. If you look over the last 20 years, what the S&P 500 has done. If you just had a 1-year time frame, 74% of the time you were up, but boy, 26% of the time you did lose money, right? You got into that market and it happened to be, the pandemic, right? And you potentially saw that quick loss or that great recession, right? But if you extend that over and say, I'm going to invest over the next 5 years, boy, your chances of seeing positive returns, right, went up to 84%. You look at that over 10 years, 92%, and over 20 years, right, time periods, 100% of the time there was it generated a positive return 100% of the time. Okay. So keep that long-term focus. That's an important principle. Fifth principle, compounding and how it works. If you've ever been to an enrollment 401k meeting, hopefully somebody talked to you about compounding. One of my favorite quotes on compounding is Albert Einstein, who said it's the eighth wonder of the world. Those that get it earn it. Those that don't pay it. And of course, what compounding is getting in early, getting your money working for you, investing it, allowing the returns and the dividends and the income that you receive and the appreciation in your investments to start working and gaining more for you. Here's a 6% return of an investment of $10,000. 40 years later, that's appreciated to $102,857, right? A 5% return, you're at 70 grand. A 3% return, right, at $32,000. Getting that money working for you so that you can, right, push back and of course hopefully earn more than inflation so that you can accumulate enough money for retirement. All starts by starting early and letting it start working for you and taking advantage of compounding. The sixth principle, we're kind of working our way down here, the diversification benefits. We talk a lot about diversification. It's an important aspect of investing. And this is a really interesting chart. A lot of colors here, but this goes back from 2005 to 2014. And on the next slide, it goes from 2015 to 2024. But I'm going to go back here to 2005. What this is showing us is which area of the market, all right, was the best performing up on top. So in 2005, it was commodities with a 21.36% return, followed by international, followed by REITs, small mid-cap, then a diversified portfolio. This is the black. Now, diversified portfolio is in this example, is an equal weighting of all of the other areas of the market. So large cap, large cap growth, large cap value, cash, bonds, and global bonds. So this diversified is an equal weighting of all of those. And what you notice is this dark diversified portfolio tends to hover right there in the middle throughout time. So in this from '05 to 2014, it averaged a 6.06% return. Now, yep, in 2014, if you looked back over those 10 years, boy, we'd have loved to have been in small and mid cap. It had a positive 8.72%. Cash, though, only 1.46% return, and commodities, a negative 1.86% return over that decade. So if you'd have put $100,000 in 2005, at the end of that decade, you'd have had $82,000 if you were solely invested in commodities, right? Whereas a diversified portfolio, you were sitting at $180,000. If we go to the next decade, from 2015 to 2024, large cap growth outperformed, especially recently, of course, with artificial intelligence. These very large tech companies have done extremely well the last couple of years, and large growth averaged 12.56% over the decade per year. That $100,000 portfolio in large growth over those 20 years would have now been worth $1 million, right? Commodities, though, if you were 100% still in commodities at the end of that 20 years, you lost money. You'd lost 0.3% over that decade. So this is where diversification, we don't know what's going to win. We don't know what's going to lose. You can see the randomness based on the dynamics of our market and which areas outperform and underperform. And diversification is simply saying, boy, we're going to own a piece of all of this, and you end up with over the last 20 years historically with that positive return of 6.22% and a nice appreciation of $334,000 on your $100,000 investment. All right, so this is just the importance of diversification. And the areas we looked at were cash and bonds and global bonds, the diversified portfolio. We had commodities, international, large cap, and REITs and small cap. Seventh principle, and we only have one more principle to go after this: investment should align with your goals. Okay. This is a really fascinating chart about withdrawal rates. So for most of us, right, if you're saving for retirement, at some point, after years of accumulating money, right, you're going to want to start utilizing that money to live off of in retirement. And the portfolio that you have should then make sure it's addressing what your goals are and what your needs are. So for example, somebody who wants to take a withdrawal of 8% a year of their portfolio. Right here, we're listing the percent chance that payout is going to last for the next 30 years. So an 8% is an aggressive withdrawal rate. It's very difficult to take that much money out of your portfolio every year and have it last for you. But if you're going to try to attempt to do that, being in 100% U.S. equities, right, over this time period, gave you a 50-50 chance that at least your money would have lasted 30 years. If you take off less risk, and less risk usually means lower returns, you'll notice that the chances of actually achieving that 8% withdrawal rate for 30 years dramatically goes down. But I want to point out what a 4% withdrawal rate looks like, right? Because with a lot of planners and talk about in general a 4% withdrawal rate, at 100% U.S. equities, it's a 97% chance that you're going to your money would last you for 30 years if you're only taking out 4% a year. But why would you take that additional risk when a more balanced approach of 60% stocks, 40% bonds, or even a more conservative 60% bonds, 40% U.S. equities gives you 100% chance? Historically speaking, looking at past returns here, of your portfolio lasting for 30 years, and by taking on less risk by not investing in stocks. Okay, so this is what's important. Asset allocation and withdrawal rates are key to achieving your goals. Looking at these numbers, how much you need, how much you're taking out, and your portfolio representing kind of achieve what you're looking for is an important aspect to remember when looking at retirement. All right. And then the last goal I have here, and this is, I think, a really important one. We've been here at the Noble Group talking about this really since the beginning of the year, is rebalancing. Rebalancing and the importance of rebalancing. Now, rebalancing is simply that in this example, somebody in 2015, January 2015 to the end of 2024, last year, the end of last year, who invested 50% of their portfolio in bonds and 50% in stocks, and then they didn't touch it. All right, they just left it there. They did not rebalance. So the original allocation on January 1st of 2015, 50-50. If you just let that go and didn't rebalance it at the end of 2024, your portfolio now has 75% stocks and 25% bonds. You are now, of course, a much more aggressive investor because bonds, which take less risk than equities and stocks, is now only representing a fourth of your portfolio, where it used to represent a half. And of course, this is because of the appreciation of stocks over that time period. And this is what it's really important to either be in a diversified portfolio that does rebalancing for you, or actively setting that up, or working with an advisor to help you make sure that you're kind of selling and rebalancing those stocks and those investments that have appreciated to maintain, if this was your goal, maintaining that more moderate approach over the time period. It's just important to stay on top of that, because without knowing it, this investor became much more aggressive. And of course, everyone likes being aggressive when markets tend to go up, but when volatility hits and there's a pullback, it's really then that people start understanding what volatility means. Meaning, you kind of have to bear those downturns, those bear markets, those pullbacks, those max drawdowns that we've talked about, in order to, over the long term, take the appreciation that we've seen in those investments. All right, so those were the 8 basic principles. I tried to keep it, right at 30 minutes, and we're right there. I really appreciate you all attending. I'm going to see here. I've got my information up on this screen. I'm Jarrod Hageman, a certified financial planner. I've got my email. Feel free to email me if you have any questions, or you'd like to meet. My phone number here as well. I'm happy to meet, answer any questions that you have. And then also, let me just take a peek here. If there's any questions, if you had a question, feel free to write that out. I do have a question. For a starter investor, what would be a good starting amount to start a portfolio with the goal of saving for retirement? What would be a good starting amount? Well, when I think about amounts, I go back to kind of general recommendations for most people, which is a savings rate of 15%. For the average investor, if you're kind of throughout your working career, if you can hit a savings rate of closer to 15%, and a savings rate is not only what you're saving from your compensation, but also any employer match, if that's available, and employer contributions. But if you can hit that 15% savings rate kind of throughout your working career, that is, when we look at the numbers, is going to be a really a great head start for you. And of course, the younger you are, generally it makes sense to be more aggressive, investing a greater percentage of those savings in stocks. And then as you approach retirement, making sure that you're talking with a professional here at the Noble Group, or an advisor, or being in a professionally managed target date fund that might de-risk for you as you get closer to retirement. But those are kind of some general guidance that I hope is helpful. Any other questions? Then feel free to post those out on the Q&A, and I'll be happy to answer them. Otherwise, thank you so much for attending. Really appreciate it. I'll hang out here for a quick minute. But anyway, just have a great day. Oh, I do have one more here. Should the average person just stick to the fundamentals during bear markets rather than making changes? That's a great question. Of course, every individual's situation is different. right? And even in bear markets, there can be cases where it still might make sense to make a change, right? There might be other factors, whether that be health or impending retirement or income changes. Lots of different factors in which we you should consider. So you can't kind of make that decision in a vacuum. But in general, right, during a bear market, that is the worst time to sell, especially if you're invested in stocks, because you're selling when the market's down, right? And the whole point of investing and taking on the risk of investing in areas like stocks that tend to go up and down is that over long periods of time, right? We're hoping to achieve those higher rates of return. And if you sell in that bear market and locking in that loss, what the average investor then does is get back in after the recovery's happened. And it's a surefire way to not do well in investing is if you're selling when it's down and you're buying when it's up. So yes, in general, you should absolutely kind of stay the course. As I mentioned, though, there can be factors in which it might make sense to make a change. Um, let's for an employee older than 40, is there still time to have a retirement plan? That's a great question, and the answer is yes. Right, the best time to start is 20 years ago, and if not, then now. Right, so even at 40, there's so many things that you can do. Right, retirement for many people is now later and later, depending on what you're doing and how long you want to work. Starting and getting a plan, getting a savings rate in place. There's so many things that you can do to really kind of prepare for a retirement. Boy, if you start at 40, it's easier to do it at 40 than 50. The right time to start is today. All right. With that, I think that does. Could you describe some of the benefits or drawbacks of a high yield savings account? That's a good question. Of course, interest rates are a little higher right now, so there's high yield savings account. When I think about high yield savings account, I tend to think about emergency funds. It's important, from a planning perspective, to have several months worth of income set aside for that emergency, whatever that might be, whether it's car maintenance um, or income disruptions, and putting that money somewhere where it's liquid and you're able to get to it, maybe in a high yield savings account that's FDIC insured. That can be very appropriate for a lot of individuals. Of course, it's giving you a higher rate of return on that cash that you have than say a checking account, which is optimal, right? We want to try to optimize your return wherever that might be, but also keep that money if it's targeted for an emergency or for just cash on hand, liquid, so that you can have access to it. You can get to it. So yeah, no, I think high yield savings accounts have a for getting money and accessing it quickly is a great way to go. If you were to ask me, should I do that instead of maybe investing, right? It's going to depend on your risk tolerance and kind of what your goals are. But over time, investing in stocks, investing in bonds over the long term have outperformed cash. So that's also something to just take in consideration. With that, it looks like the vast majority of questions. Yeah, I think that's the last of the questions. So with that, I just want to say thank you again. Really appreciate you attending. Feel free to reach out to me if you have any follow-up questions, and appreciate the partnership with the Noble Group. All right. With that, have a great day and take care.